Hello everyone. Today let's look at an impressive example that shows market optimism, the case of Carnival. For the past 18 months, the cruise company, like others in the sector, has burned billions in cash to maintain its fleet. In April 2020, at the height of the stress, Carnival managed to issue a bond. It was $4 billion collateralized by billions of assets, 4-year maturity and a coupon of 11.25%, which represents $450 million in interest to be paid every year. New bonds followed, always financially attractive, but every time less income and less guarantees until Carnival was able again to issue without collateral. So, okay, that's reassuring, but Carnival's credit rating fell as quickly as its leverage increased to levels that are difficult to sustain. So how can they reduce this leverage? Well, they can either increase revenues and or lower debt, or at least reorganizing it. At the beginning of October, Carnival announced that its US fleet would be back in operation next spring. So is this a good news for revenue? Well, not completely yet, because in order to get the ships back into operation, Carnival will have to burn more cash. At the end of the third quarter, liquidity had fallen to $7.8 billion and $510 million of cash were burned every month. Restarting the fleet involves costs, so in Q4, more cash will be burned. So the company aims to return to break-even revenues by the spring 2022. And in the meantime, Carnival is successfully focusing on its balance sheet. How? Well, it started at the end of June with the first syndicated loan. This loan was a $2.5 billion loan, maturity 2025, and a cost of 4% per annum at this stage. The amount has allowed the early redemption of $2 billion of the 11.25% collateralized bond issued in April 2020. That can seem trivial, but it means a saving of more than $100 million per year in interest. Not stopping there, the group issued a new bond in July and announced early October that it was looking for a new $1.5 billion syndicated loan maturing in 2028. This new loan will allow the company to continue to repay the 11.25% bond, which will provide significant savings. It will free up assets, extend the average maturity of the debt, and also it will continue to lower the 2023 maturity wall. However, Carnival will need to return to break-even earnings in spring at latest if it wants to meet its 2022 commitments. But the market is not worried about the potential cash shortfall. It is confident that the cruise line's brilliant trajectory will continue, and it is currently enjoying the ride. Thank you.